Welcome back to Investing Talk podcast. Today, we're tackling a question quite a few of you have asked us to look into. Is Mill City Ventures III a good time to buy now? You've sent us your sources, articles, research notes, and we've been sifting through them to bring you the most important insights on this company. Our goal here is really just to unpack the key details, look at it from different angles, and, help you understand what might be going on behind some of the recent headlines around Mill City Ventures III. Before we jump in, if you're finding these analyses helpful, please do remember to subscribe, like, and comment. It really does help us out. And if you'd like to support the show, maybe consider buying us a coffee. Also very important, if there's a specific company you want us to look into, just leave a comment below and we'll absolutely see if we can get to it. Okay, so let's unpack this. Mill City Ventures III. It operates as a principal investment boutique, right? Specializing in debt and equity securities financing for private and public companies. Sounds pretty specialized.
It does sound complex, yeah. But what's fascinating here is that their CRIM function is essentially just investing in and lending to other businesses. Pretty straightforward at its heart. The sources we looked at highlight they have about $3.25 million in trailing 12-month revenue. That's their income over the past year, UTM. And a net income of around $1.24 million.
Okay.
So that results in a positive net margin of about 38%, which, that's quite healthy for an investment firm. Shows modest but definitely profitable operations.
Modest but profitable. Okay, I get that. But here's where it gets really interesting, something that just jumped out from the sources. The company has a market cap of around $35.77 million and only 2 employees.
Yeah.
2 employees handling an investment firm. That's incredibly lean.
Indeed. It really is. This small scale and niche focus, it suggests a very specialized approach, maybe quite agile.
Yeah.
But it also implies a pretty limited competitive moat compared to the much larger financial players out there.
Less protection.
Exactly. And if we connect this to the bigger picture, it means they might just have less resilience against broader market shifts or, competition from established firms with way more resources.
So what does this all mean for someone looking at this company then? Are there any immediate red flags from a fundamental perspective just based on that structure?
Well, it definitely raises an important question regarding their debt and cash flow, which aren't really detailed in the sources we have. And for an investment firm, this data is absolutely crucial for assessing liquidity risk. Can they pay their bills?
Yeah, vital.
Also, a significant point is the lack of a forward PE ratio, a forward price-to-earnings ratio. Now, this indicates uncertainty, or more likely, just a lack of analyst coverage on their expected earnings growth.
Oh, okay. No one's forecasting.
Pretty much,
Sure.
Which makes it really difficult to project their future performance based on the current information we've got.
Right. That lack of visibility is tough. Okay, now let's talk valuation. This is where things get a bit, perplexing, even for us looking through the sources. We have conflicting data points for the price to earnings, the PE ratio, ranging from like 9.2x all the way up to around 30x. What should we make of such a wide discrepancy? That seems pretty fundamental.
It really does. And this is a prime example of why looking at multiple sources is so important. The PE being near the sector average or maybe high, depending on which source you trust. It could just be due to volatility or maybe outdated ratios being used somewhere. It immediately signals caution. It highlights the need for clarification because a company's PE is usually a pretty fundamental indicator of how expensive it is relative to its earnings.
Okay, so the key E is a bit of a mystery, a red flag right there.
Yeah.
What about other metrics like price to book and price to sales? Do they help clear things up?
Not really. They actually give us kind of a mixed picture. The price to book ratio for Mill City Ventures there is 0.6x. Now that's below the sector average of 1.0x.
Okay, so maybe undervalued based on assets.
Could suggest that, yeah. Potential undervaluation relative to its book value. However, its price-to-sales ratio is 3.5x, which is actually higher than the sector average of around 2.1 to 2.7x.
Ah, so expensive relative to sales.
Exactly.
Yeah.
It implies a premium price relative to its sales. So yeah, we're seeing mixed signals. Not exactly helpful. And then if we look at the PEG ratio, the price earnings to growth ratio, it's 0.00.
0. Usually low is good.
Well, usually, yeah. A low PEG sounds good, suggests value relative to growth, but a 0 PEG, that likely reflects insufficient or, frankly, no growth estimates available. which lines up perfectly with that lack of forward PE data we mentioned.
Right, it all connects.
And our sources also mentioned some potential upside, maybe around 41.7%, suggested by some fair value estimates. But, and this is a big but, this lacks confirmation. There's no detail on how they got that number.
So basically, don't bank on it.
Definitely not something to bank on, no. It's speculative.
All right, here's where it gets really interesting, or maybe really wild is the better word. The stock price for Mill City Ventures III surged dramatically. Within 24 hours, it went up approximately 219% to $6.80, and its 52-week range before this was like $1.13 to $6.64. So this just blew past the high end. What does such a rapid spike tell us?
Well, it tells us almost everything about the current mood. It shows extremely high volatility and strong speculative trading behavior. That's the main takeaway. The sources indicate the stock just broke out, smashed above prior resistance levels, probably somewhere around the $2 to $3 mark.
Just shot straight up.
Yeah, and when we see such rapid price appreciation, it almost certainly pushes momentum indicators way into overbought territory,
Right.
which signals caution, big caution, for potential buyers thinking of jumping in now. It suggests the move might be overdone.
Okay, overbought. Makes sense.
And if we connect this to the bigger picture, the beta for Mill City Ventures III is also very high, somewhere between 1.31 and 1.39 in the source.
One's more volatile than the market overall.
Exactly. Yeah. Significantly more volatile. And you combine that with volume surges up to 116 million shares traded.
Wow.
It just reinforces this narrative of high price volatility and speculative trading, not necessarily fundamental strength driving it.
So, okay, was there a big announcement then? Did something actually happen to spark this surge? New contracts, a major acquisition, anything?
That's the really interesting part.
Oh.
Our sources note no major news. No upgrades, no downgrades explicitly mentioned.
Nothing.
Nothing concrete. There's no insider buying or selling data available either, which you'd often look for. The buzz just appears to be driven by social media and the incredibly high trading volume. We're seeing huge short-term price moves, gains of 85% or more over short periods mentioned.
Okay.
Which again, it points straight to speculative interest, momentum chasing, rather than any fundamentally driven catalysts.
Given all this volatility and speculation then, what are the potential events that could actually move the needle for Mill City Ventures III in the near future? Are there any actual catalysts coming up?
Well, the most immediate specific catalyst mentioned in the sources is their next earnings report. That's scheduled for August 13, 2025.
Okay, so that's a date to watch.
Definitely. It could provide more clarity on their financial situation, maybe fill in some of those debt and cash flow gaps we talked about. Beyond that, our sources really didn't find any public announcements on, say, product launches, major M&A activity, or significant regulatory things that might impact this specific company.
So it really hinges on that earnings report for now.
Seems like it, yeah. That's the main known event.
Okay, so the upcoming earnings are the big one. But let's pivot to the risks. What should a potential investor be really, really aware of here? It sounds dicey.
Yeah, this raises an important question, absolutely. And the risks are substantial based on our sources. From a stock-specific view, it's extremely small market cap and float. That's the number of shares actually available to trade lead to significant liquidity risk.
Meaning it's hard to get in and out without moving the price.
It's exactly. Hard to buy or sell large amounts quickly without affecting the price, sometimes drastically, and it makes it prone to price manipulation or just sharp swings. There's also that limited analyst coverage and the unclear forward earnings projections we keep coming back to. That just adds to the uncertainty.
Right. Lots of unknowns.
And then, at a broader level, you have sector risks. Investment firms like this face credit risk borrowers defaulting. They face market fluctuations affecting their investments and interest rate changes impacting portfolio values. Plus, macroeconomic risks like rising interest rates across the board or an economic downturn, that could really hurt debt servicing and the value of their assets.
And the volatility itself is a risk.
A huge one. As we've discussed, the beta over 1.3 and those recent massive price moves mean this stock carries extremely high volatility and risk. Especially, I'd say, for inexperienced traders maybe drawn in by the big percentage gains.
Okay. So after breaking down the fundamentals, such as the confusing valuation, the wild technicals, and these significant risks, what's the final verdict? Is Mill City Ventures III a good time to buy now? What does our analysis tell us?
Well, based on our analysis of all the sources provided, the company received an overall rating of 3.5 out of 10. So pretty low.
3.5 out of 10. Ouch!
Yeah. While Mill City Ventures III does show that modest profitability we noted, it operates at a very small scale, has thin analyst coverage. The valuation appears mixed, Maybe some undervaluation by one measure, but a premium by another, and, definitely a lot of speculation-driven price jumps lately. The technicals clearly signal an overheated price with very high volatility and risk, and crucially, there are no strong fundamentals or clear positive catalysts that seem to justify that current massive price surge. The downside risks are significant.
So the recommendation.
Therefore, for long-term investors, Mill City Ventures III is not recommended, period. Given the lack of growth visibility, its small scale, and those high volatility risks, it just doesn't fit a long-term profile.
Yeah.
It's really only suitable for very high-risk, speculative short-term trading, even then.
Yeah. What about for those very high-risk traders? If they were even going to consider it, what did the source material suggest?
Well, if considering short-term trading only, and with extreme caution, our sources suggest maybe watching for a pullback. Perhaps below $3 to $3.50, that might represent a more reasonable support zone after these recent spikes.
Okay, a potential entry zone maybe?
Potentially. And for risk management, absolutely critical here, a stop loss around 30–40% below entry is suggested purely because of its volatility. So, for example, if you entered near $3.50, you'd be looking at a stop loss around maybe $2 to $2.40. That's a wide stop, reflecting the risk.
And getting out, taking profits.
Scaling out near the prior highs, around $6.50 perhaps, or using trailing stops to lock in any gains if it does move favorably. But again, that's for highly speculative, active trading. Ultimately, this summary is crystal clear from the sources. Exercise extreme caution.
This has been a fascinating and, definitely a cautious look at Mill City Ventures III. It really highlights how important it is to look beyond just the headlines or a crazy chart pattern and try to understand what's really driving a stock's price, or if it's just, pure speculation.
Absolutely. The story of Mill City Ventures III truly underscores that. Even profitable small companies can become highly speculative instruments in the market without any underlying fundamental justification for those extreme price moves. You always have to consider the why behind the what's.
So what does this all mean for you listening? Perhaps it's a reminder that, well, not every exciting chart offers a compelling investment opportunity. Sometimes the most valuable insight is knowing when to just stay on the sidelines and watch. Thank you for joining us on this exploration today. We hope this analysis helps you make more informed decisions about your own investing journey.